Right at this very moment, while you're watching this video, the global banking system is sitting on a financial time bomb worth over $200 trillion in derivatives. That's not some abstract number pulled from thin air. That's 3 times larger than the entire world's economic output. And here's the truly terrifying part. It's all interconnected like a house of cards. When one institution falls, they all come crashing down together. You probably think 2008 was catastrophic. Lehman Brothers collapsed with $600 billion in assets, nearly bringing down the entire financial system. But what's brewing right now makes that look like a minor market hiccup. We're talking about institutions that are 10, maybe 20 times larger than Lehman, all teetering on the edge of collapse. This isn't some doomsday prediction based on fear or speculation. This is pattern recognition backed by over 2,000 years of documented financial history. And the pattern is crystal clear. We're already deep into the crisis stage. Most people just haven't realized it yet. Let me show you something that will fundamentally change how you understand what's happening to our economy right now. Throughout recorded history, every major banking collapse follows an identical 4-stage pattern. Not similar, identical. I'm going to prove this using 3 historical examples separated by centuries, then reveal exactly where we stand in that cycle today. Stage 1 begins with foundation and trust. A period of stability creates confidence. Confidence encourages lending. Lending fuels expansion. Everything feels secure and predictable. People forget that financial stability is always temporary. They forget that every economic boom plants the seeds of the next devastating bust. Stage 2 brings dangerous overextension. Credit expands far beyond real underlying assets. Banks leverage themselves 30 to 1, 40 to 1, sometimes even more extreme ratios. Complex financial instruments multiply like cancer cells. Risk gets buried in derivatives so complicated that nobody truly understands them. Not the people creating them, not even the regulators supposedly watching them. Stage 3 arrives with the crack. Something breaks the facade. Could be a bank run, a major default, or a geopolitical shock. But here's the critical point you must understand. The crack doesn't actually cause the crisis. It simply reveals the hollow foundation that was already there all along. Stage 4 unleashes the collapse. Contagion spreads faster than anyone thought possible. Liquidity vanishes overnight like water down a drain. Banks that seemed invincible yesterday are begging governments for bailouts today. Central banks frantically print money. Currency values plummet. And then the cycle begins again. 4 stages. Always the same sequence. The only variables are the names on the buildings, the dates on the calendar, and the scale of financial destruction. Now I'll prove this pattern using 3 devastating examples from history. Rome, 33 AD. The mightiest empire in human history operated a surprisingly sophisticated banking system. Private lenders, extensive credit networks, aggressive real estate speculation. Sound familiar? It should. Stage 1 was already complete. Decades of Pax Romana had created unprecedented stability. Roman banks lent aggressively to citizens, borrowing for everything. Land purchases, business ventures, luxury goods. The economy was booming like never before. Then Stage 2 hit with brutal force. Emperor Tiberius discovered something deeply disturbing. Lenders were completely ignoring a fundamental law requiring 60% of all loans to be backed by Italian land as collateral. They weren't just bending this critical rule, they were obliterating it entirely. Credit had expanded far beyond any real backing. Banks were leveraged to degrees that would shock even today's reckless investment banks. Stage 3 arrived without warning. Tiberius suddenly enforced the law strictly, giving lenders just 18 months to comply. Instant panic swept through the system. Banks desperately called in loans to meet the requirements. Borrowers couldn't repay. They had to sell property, lots of property, all at the same time. When everyone sells and nobody buys, real estate prices collapse overnight. The credit market froze completely solid. Even wealthy senators couldn't access basic liquidity. Money simply evaporated from the system. Stage 4 brought Rome to its knees. The Roman Senate had to inject 100 million sestertii into the banking system, an absolutely staggering sum for that era. They created emergency 3-year interest-free loan programs just to prevent the empire from imploding financially. Think about that for a moment. The greatest empire in ancient history nearly fell apart because of a credit crisis. Not military defeat, not barbarian invasion, a banking crisis. Roman citizens believed their financial system was invincible right up until it wasn't. Fast forward 14 centuries to Florence, Italy, the 1490s. The Medici Bank had dominated European finance for 60 years. They financed popes, kings, entire wars. They were the J.P. Morgan of the Renaissance, the most powerful financial institution on earth. Stage 1 had been built over decades. The Medici established their empire on trust and initially conservative lending practices. They became Europe's go-to financiers for the elite. They seemed untouchable, permanent. Stage 2 arrived slowly, then suddenly. As the bank expanded across Europe, Branch managers started making increasingly risky loans. They lent massive amounts to European royalty. Why? Because you don't say no to kings, even when the collateral is questionable, even when the debt becomes clearly unsustainable. The English monarchy alone owed the Medici over 50,000 florins. King Edward IV borrowed heavily to finance his military campaigns. The loans kept growing. Branch managers kept lending. Nobody wanted to be the person who refused a king's request. Stage 3 struck when Edward lost power in 1471. He fled England and never repaid a single florin. The Medici London branch collapsed immediately. The failure of one branch triggered panic about all the others. Depositors across Europe started asking uncomfortable questions and withdrawing their funds. The dominoes began falling. Stage 4 was absolutely brutal. By 1494, the entire Medici banking empire was gone, dissolved, finished. 60 years of dominance erased in less than 3 years. What killed them? Bad loans and overextension. The exact same pattern Rome experienced 14 centuries earlier. Let's examine something more recent, something your grandparents might remember. America in the 1920s, the Roaring Twenties. Prosperity, innovation, jazz music. Everyone was getting rich, or at least that's what they believed. Stage 1 was complete by 1925. Post-World War stability created an economic boom. Stock markets soared. Banks were lending for everything: cars, radios, refrigerators, and especially stocks. Stage 2 accelerated dramatically. Banks offered margin loans requiring just 10% down payment. Think about what this means. You could buy $10,000 in stocks with only $1,000 of your own money. The other $9,000 was borrowed. Beautiful when it works, catastrophic when it doesn't. By 1929, total margin debt exceeded $8 billion, over $140 billion in today's money. Banks had loaned out more money for stock purchases than they could ever recover if prices fell, but nobody thought stock prices would fall. This was the new era. Old economic rules didn't apply anymore. The economy had reached a permanently high plateau. Those were actual quotes from leading economists. Stage 3 hit on October 24th, 1929, Black Thursday. Stock prices dropped just enough to trigger margin calls. Borrowers had to sell stocks to repay loans. More selling meant lower prices. Lower prices meant more margin calls. A death spiral that was self-reinforcing and unstoppable. Stage 4 destroyed America. Between 1930 and 1933, 9,000 banks failed, roughly 40% of all American banks. Depositors lost the equivalent of $140 billion in today's dollars. Unemployment hit 25%. The banking crisis turned a stock market crash into the Great Depression. 3 examples, 3 different civilizations, 3 different centuries. One identical pattern, same stages, same progression, same devastating outcome. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Now let me show you why 2008 was just a preview, a warning shot, and why what's coming next will make it look like a minor correction. We're not just in stage 2 anymore, we're somewhere between stage 2 and stage 3. The cracks are forming, and most people have absolutely no idea. After the 2008 financial crisis, central banks did something unprecedented in human history. They dropped interest rates to 0 and below in some countries. Then, they started printing money on an unimaginable scale. The Federal Reserve alone created over $4 trillion between 2008 and 2014, then another $5 trillion during the pandemic. That's $9 trillion created from thin air in less than 15 years. Why this massive intervention? To stabilize the system? Create trust, make people believe the crisis was over, rather than admitting they'd just given the patient powerful painkillers instead of actually healing the disease. And it worked temporarily. By 2010, markets stabilized. By 2012, they were growing. By 2015, new all-time highs were reached. People forgot about 2008 because remembering is uncomfortable and their retirement accounts were growing. They forgot that the fundamental problems were never actually solved, just papered over with freshly printed money. Stage 1 complete. Trust restored, foundation rebuilt on quicksand. Since 2008, global debt has absolutely exploded. Total world debt now exceeds $300 trillion. Let me repeat that staggering number, 300 trillion. That's up from 160 trillion in 2008. We nearly doubled global debt in 15 years, while supposedly recovering from a debt crisis. Does that make any logical sense? Solving a debt crisis with more debt is like treating a hangover by drinking more alcohol. Corporate debt in the United States alone is now $11 trillion, up from $5 trillion in 2008. Corporations borrowed cheap money and used it for stock buybacks, dividend payments, and acquisitions. Not to build factories, not to hire workers, not to invest in productive capacity, to engage in financial engineering designed to manipulate earnings and boost executive compensation. But here's the real danger that should terrify you: leveraged loans and collateralized loan obligations. If those terms sound unfamiliar, let me translate. They're the new subprime mortgages. Risky corporate loans to already heavily indebted companies, bundled together, sliced up, and sold to investors who often don't fully understand what they're buying. The leveraged loan market is now $1.4 trillion. Collateralized loan obligations total $900 billion. These are loans to companies rated below investment grade, companies that might not survive if interest rates rise or the economy slows down. And remember those derivatives I mentioned at the beginning? Over $200 trillion in notional value. These are essentially bets on bets on bets. Financial instruments so complex that even the banks holding them can't fully calculate the risk. Bank leverage ratios remain dangerously high. You'd think after 2008, banks would be more conservative. Some are safer, but many aren't. Deutsche Bank's leverage ratio in 2024 was still around 25 to 1. Credit Suisse collapsed in 2023 with leverage over 30 to 1. These institutions hold trillions in assets, but have only a thin slice of actual capital backing them. If their assets lose just 3 to 4% of value, they're technically insolvent. Stage 2 isn't just complete. We're dangerously deep into it. The overextension is massive. The risk is hidden in complex instruments. Check, verified, undeniable. Stage 3 might have already started. Most people haven't noticed yet, but the cracks are definitely forming. March 2023, Silicon Valley Bank collapses. The 16th largest bank in America, gone in 48 hours. It was the second largest bank failure in American history. Signature Bank failed the same week. First Republic Bank failed 2 months later. 3 major banks gone in 8 weeks. Why did they fail? Rising interest rates exposed a problem hiding in plain sight. These banks bought long-term government bonds when rates were near zero. A safe investment, right? But when the Federal Reserve raised rates from 0.25% to 5.5% in less than 18 months, those bonds lost tremendous value. Silicon Valley Bank had $120 billion in deposits, but couldn't honor withdrawal requests because their money was tied up in underwater bonds. When depositors panicked and tried to withdraw $42 billion in a single day, the bank couldn't cover it. They collapsed in 48 hours, from healthy to dead in 2 days. The Federal Reserve and Treasury created the Bank Term Funding Program, allowing banks to borrow against underwater bonds at face value. They papered over the problem again, but hundreds of other banks are sitting on similar unrealized losses. As of late 2024, American banks hold over $500 billion in unrealized losses on their bond portfolios. That's the crack in the foundation. Commercial real estate is imploding. Office buildings sit empty due to remote work. Shopping malls are dying due to e-commerce. These properties were financed with massive bank loans that are now going bad. Commercial real estate loans at American banks total $3 trillion. If even 10% default, that's $300 billion in losses banks might not absorb. The Bank of Japan and the yen carry trade represents another massive crack. For decades, Japan kept interest rates at zero, creating the yen carry trade. Investors borrowed yen at 0%, converted to dollars or euros, and invested in higher yielding assets worldwide. Estimates of the carry trade size range from $4 trillion to over $20 trillion. In 2024, Japan started raising rates for the first time in 17 years. Suddenly, the carry trade wasn't profitable. Investors had to unwind positions, selling assets and buying back yen. In August 2024, we saw a preview. The yen surged 13% in 3 weeks. Global stock markets dropped 5 to 10% in days. These are cracks forming simultaneously. Silicon Valley Bank, commercial real estate, the yen carry trade, unrealized losses across the banking sector. Stage 3 is here. The only question is how fast it accelerates. Stage 4, the collapse, hasn't fully arrived yet, but the mechanics are already in motion. The sequence is predictable. It starts with contagion. One major bank fails, maybe a European bank, maybe a large American regional bank with commercial real estate exposure. The failure triggers counterparty risk. Remember those $200 trillion in derivatives? Many contracts are between banks. If one fails, others are suddenly exposed to contracts that won't be honored. Their capital ratios fall below minimums. They become vulnerable. Depositors panic instantly. Bank runs accelerate, but now they're digital. You don't need lines outside banks anymore. $42 billion can be withdrawn in 24 hours with smartphones. Governments step in with massive bailouts. In 2008, the total U.S. bailout was around $700 billion. The next crisis could easily require double or triple that amount. Governments will do what they have done for 2,000 years. Print money. Massive amounts of money. They have no choice because letting banks fail means the entire payment system collapses. But printing that much money has inevitable consequences. Currency devalues, inflation spikes, not the 5 to 6% we saw recently, but potentially double digits, 10, 15, 20%. Savings evaporate. The middle class gets hollowed out. Many economists believe this is manageable. They think they can bail out banks without triggering hyperinflation, stabilize the system without collapsing currency. They're wrong. The mathematics don't work. You cannot sustain $300 trillion in global debt with near zero interest rates, and then raise rates without breaking something fundamental. Every central bank knows this. That's why they're trapped. Raise rates too much and trigger debt crisis. Keep rates low and inflation destroys purchasing power. There is no good option, only bad options and worse options. Technology doesn't change this pattern. High-frequency trading and artificial intelligence make transactions faster, information flow faster. They don't eliminate human psychology, greed, or fear. If anything, technology accelerates panic. Bank runs happen in hours instead of days. Central bank coordination might help temporarily, but it won't solve underlying problems. In 2008, coordination delayed the crisis but made it bigger by adding more debt to an already overleveraged system. America being the reserve currency provides some protection, but Rome thought they were invincible too. The Medici thought royal connections made them untouchable. American banks in 1928 thought they'd eliminated business cycles. Exceptionalism is a comforting lie. The pattern is mathematical. When debt exceeds capacity to repay, when leverage exceeds ability to absorb losses, when derivatives exceed ability to unwind them cleanly, the system resets. Always. History doesn't repeat exactly, but it rhymes loudly. So what happens next? Short term, meaning the next 6 to 18 months, volatility increases dramatically. Market swings become more violent. 10% drops followed by 5% rallies. This isn't normal price discovery. This is a system under extreme stress. Watch credit markets, not stock markets. When corporate bonds yield significantly more than government bonds, that signals fear. When high-yield spreads exceed 700 basis points, that's panic. Watch regional banks holding commercial real estate loans and underwater bonds. When they start failing, contagion begins. Watch currency markets carefully. If the dollar suddenly strengthens dramatically, that's global liquidation. Everyone trying to get safe. If the dollar suddenly weakens dramatically, that's confidence collapse. Either scenario is dangerous. Medium term, meaning 1 to 3 years, government intervention accelerates. More bailouts, more stimulus, maybe even direct payments to citizens. They'll call it economic support or universal basic income. What it really represents is currency debasement, wealth transfer from savers to debtors, from responsible to irresponsible. It's a hidden tax, and it's massive. Long term, meaning 3 to 10 years, the system resets either through hyperinflation, which destroys debt by destroying currency, or through deflation and defaults, which destroys debt through mass bankruptcy. Both outcomes are catastrophic in different ways. I suspect they'll try inflation first because it's politically easier, then get deflation anyway when that fails. What should you do? How do you position yourself for this inevitable crisis? First, understand your exposure. Analyze how much of your wealth depends on the current system functioning normally. Bank deposits beyond insurance limits, corporate bonds from overleveraged companies, overleveraged real estate, money market funds holding commercial paper. These are vulnerable when crisis accelerates. Second, diversify into hard assets. Not necessarily selling everything for gold bars, but having exposure to assets that maintain value during currency debasement. Gold, silver, commodities, even Bitcoin for some investors, though it's volatile and unproven through real crisis. Real assets in a world of financial assets. Things that can't be printed. Things with value independent of government promises. Third, reduce personal leverage aggressively. Pay down high-interest debt, especially credit cards. When credit tightens and banks get scared, revolving debt becomes dangerous. Interest rates can spike. Credit lines get cut. You don't want forced asset sales in down markets just to meet debt payments. Fourth, increase liquidity substantially. Keep more accessible cash than normal. Yes, cash loses value to inflation, but it provides options. When assets are falling, liquidity allows buying at lower prices. When systems are stressed, liquidity means survival. Fifth, educate yourself continuously. Understand what's happening from sources showing actual data and numbers, not mainstream media incentivized to keep you calm or financial media dependent on advertising from at-risk institutions. Read bank financial statements, examine bond portfolios, check commercial real estate exposure, study derivative exposures and footnotes. This information is public. Most people just don't look. This isn't about panic. This is about preparation. The pattern is clear after 2,000 years of documented history. The timeline is uncertain, but the direction is inevitable. For over 2 millennia, every major banking system following this pattern reached the same endpoint: collapse, reset, massive wealth transfer. Without exception, Rome, the Medici, the 1930s, 2008, same pattern, same outcome. We're currently in late stage 2, entering stage 3. The cracks are visible if you know where to look. This time it's truly global. Every major economy is over-leveraged. Every major central bank is trapped between inflation and deflation. Every major bank is interconnected through derivatives. When the system breaks, and it will break, there's no cavalry coming. No country with clean balance sheets ready to bail out the world. Everyone is maxed out and vulnerable. Yet most people have no idea. They're watching stock tickers, checking retirement account balances, assuming everything is fine, because the system hasn't collapsed yet, because yesterday seemed normal. But you know better now. You've seen the pattern across 2,000 years. You understand the mechanism and where we stand in the cycle. The question is simple. What will you do with this information? Will you prepare and position yourself correctly? Will you protect what you've worked for? Or will you hope it doesn't happen? Because hope isn't a strategy, and this pattern has never been broken. Not once, not ever. The crisis is coming. The pattern guarantees it. History guarantees it. Mathematics guarantees it. The only question is whether you'll be ready when it arrives. The information is here. The warning has been given. What you do next determines your financial survival. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.